want to talk today about diversification when considering investing and why it is important. When people consider investing their money, there is usually a common objective, that being to achieve greater opportunity for growth or income compared to what they have been receiving from their deposit accounts. There is a general acceptance that if you want greater opportunities for return, you have to accept an element of risk with any investment. This concept is known as risk versus reward. There are different strategies in place to help reduce risk when it comes to investing. One key one is that of diversification. In simple terms, this means investing in different types of investments in order to reduce the risk of all assets dropping in value at the same time. Through diversification, investors can offset losses on some investments with gains on others. The old adage of not putting all your eggs in one basket is a good example of diversification. Within each asset class, further diversification occurs. If we take equities, for example, a diverse investment is likely to hold stock in the UK, in developed countries such as North America and EU, and lastly, some exposure to emerging markets. Furthermore, the fund manager, who makes decisions on where to invest your money, will look to spread the money across many industries such as pharmaceutical companies, financials, and retail. This again helps reduce risk by not relying on one specific area. Lastly, within each fund, there is likely to be a large number of individual companies used, which will ensure that there isn't an over-reliance on one specific stock. In most cases, a well-balanced portfolio will contain the following asset classes. Fixed interest securities. These are more commonly known as gilts or corporate bonds. These are generally seen as lower risk investments and generally don't have the same level of fluctuation as that of equities, for example. The trade-off for more security is that these investments are unlikely to provide the same level of return as equities. Secondly, is commercial property, another asset class which basically helps diversify your portfolio. Typically, in this type of investment, the fund manager will either buy buildings, bricks and mortar, and rent out that space, or purchase shares in real estate funds known as REITs. This type of investment would be deemed higher risk than fixed interest securities, but lower risk than that of equities. Lastly is equities. Most people associate investing with this type of asset class. By investing in equities, you are in effect purchasing shares of companies. These companies may be in the UK, developed markets, or in emerging markets. Historical data highlights that this type of investment is likely to fluctuate more than other types of investments. Having involvement in all three asset classes has proven to help reduce risk over the longer term for investors. A minimum investment horizon of at least 5 years would be expected with any new investment. If you have any further queries or questions, please contact Ellis Bates.